Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about the Bank of Canada lowering their interest rates today. But more importantly, we're going to be talking about three things that are happening right now that's going to dramatically affect your investment portfolios. And I'm going to share with you where you should be investing right now over the next 6 months to a year in order to make sure that you are not getting banged up too much in your portfolio. So what are the three things? We've got an interest rate reduction, so we're moving into a period of lower interest rates. We have tariffs in the United States, an announcement coming from the Supreme Court, what that could mean for us. And then also a stalling economy, one of the worst economies in the entire world. Wait till you see the graphs on this. Okay, so I got a lot to unpack. I'll try to get through it as fast as I can. And put your comments below, like and share this video, and let's get into why you're here today. Okay. Before I begin, I talk about the Bank of Canada cutting their rates. I am an investment advisor and a licensed insurance advisor, so I manage my own client's portfolio. Many of you don't know that. Many of you think I'm somebody that does planning. That's true. I'm an advisor that does planning for Canadians right across Canada, and I do these videos to help people plan for retirement. But I also have clients where I manage their money and insurance products, and I do plans for those people, obviously. And so today I'm going to be sharing with you what I'm telling my own clients for the last 2 weeks. I've been making changes to their portfolios based on this information. So I'm sharing it with you. Okay, so let's give you the update. The Bank of Canada cut rates today by a 1/4 percentage point. I think everybody in the entire world saw this coming. And the question is, will we get another rate cut? We'll find out. There's another opportunity in December and then the new year. But rates are now 2.25%. That is good news for anybody that is getting buried in the rental market where you've got some pretty big interest costs. 1.9 million mortgages are renewing. And this is good news. We're down 1% from January, so it's been a relief to you. And any more rate cuts are going to be even better, right? And what does that mean for asset prices? When rates go low, asset prices go up. So we could start seeing some movement in terms of prices for homes and the rental market. Now, does that mean every home? No, because there's something like 50,000 condos available in the GTA, in the Greater Toronto area, that are available. So it's going to take a little bit of a while to get through those. But these additional rate cuts are going to be very useful for people as we move forward. But what is the reason that for the rate cuts? It's tariffs. There were four main reasons, and Tiff Macklin did not try to move around this. This was right off the top. The first one was tariffs have weakened the economy. It's increased the cost to business owners, and because of that increased cost, the rates, the economy is stalling. Have to lower rates. And one of the main things about the economy is that the unemployment rate is 7.1% for adults in Canada. Now, you're asking probably, well, why is he putting the unemployment rate for youth, meaning 16, say, to 21? And this is simple. I'm a father of three. And like you may have some kids. And every month, we have to dole out money to our kids. When they have jobs, when they have part-time jobs and they're working in a mall doing something, then they're helping to save for their university or college, or to pay for their car, gas money, or just some travel money to enjoy themselves. That's great. And when they're not, they come to mom and dad, don't they? And so that's like an increased tax. Now, I know it might sound like, what is he talking about? But I know, as a parent, how much money we have to give to our kids. So I'm hoping that they get a job soon, because that 14.7% is affecting families. And for lower income families and their kids are not working, that is a massive problem. So I hope the government finds some way to help kids get back to work. It's not just about money. It's about developing a sense of purpose, of a work ethic, teamwork, and just a self-worth of knowing that they are accomplishing and they're sort of standing on one leg at least, right? So I think it's an important thing. Now, the fourth reason was structural adjustment. Tiff Macklin was saying that, CPI, we call that inflation, is a cyclical kind of event where prices go up and down depending on demand, right? But structural meaning that something was placed into our economy that we need to somehow deal with, and that's tariffs. before the tariffs, it was just, I don't want to say mismanagement, but before the tariffs, there was some high inflation numbers, high unemployment numbers, and that's just more about decisions that the government makes. But when tariffs came in from the US, that was a structural, I have to agree, that's a structural adjustment that the Bank of Canada has to make. And so interest rates obviously are coming down. But what does this mean for you? This is where I get into exactly where you should be putting your money. And now you have to examine your own risk tolerance, your time horizon, your need for capital. So I'm not going to tell you buy this stock or this fund or anything. I'm just going to give you some sectors to pay attention to. But it is important that you understand that Canada is a problem. Canada was doing well, but I got to tell you, the party is over in Canada. 23% rate of return. It went down this, I did a screenshot earlier in the morning, so it fell not much further, but it did fall. And the party's over in Canada. This is finished. Our economy is effectively stalled. I think it's in recession, but it's effectively stalled. So if that is the case, are you still interested in putting your money in Canada? Let's get into that. GDP forecast by the Bank of Canada. These are their numbers. The GDP for 2025 is 1.2. It's going to be down or almost the same as this year, 1.1. And then they think 1.5. Now, I don't trust any economist telling me what's going to happen in 2027. There are so many things that happen in the world today that turn us on our heads. So I'm only looking 12 months out. That's as far as I want to see. Obviously, there are some things you can do to look a little bit further than that. But right now, I think there's too many big events that are going to change the dynamic of our economy. And so I'm going to go short term. Okay. So 1.1%. If that's the case in Canada, do you want to put your money in an economy that's not really working? Is it doing that all over the world? No. Canada is among the worst GDP growth countries in the world. This is the real GDP. This is from the OECD. They put all these reports out, right? This is real GDP growth projections for 24, 25, and 26. And what is it saying? 2026? That we're at the bottom of the page. So what does that tell you about where you should invest your money? That the real GDP growth is ex-Canada, not inside of, not part of at least Japan, Russia, Korea, Mexico, Italy, France, or Germany. Those countries are not really doing all that well, except for Korea. They have 2.2 at least. So that's an important fact for you when you're investing your money to know where you should put your money. This is important. Now, inflation is not really the problem in Canada. You can look at inflation is actually quite low comparative to everywhere else in the world. So it's not a symptom of inflation. It's a symptom of our economy is stalled, which is really weird because we have low inflation. That's what the government wanted, but we have an economy that isn't working. And we have a Prime Minister of Canada saying we have everything that the world wants, and yet our economy is projected to be one of the worst in Canada over the next 12 to 24 months. I don't understand. The messaging doesn't line up, and I hope they figure that out because we're all going to suffer while they do that. So let's look at portfolio allocation and where you should put your money. And don't read into this that I'm red or blue or I favor Trump or I don't favor Trump. I'm just giving you the facts. And you all know this, that things are not as rosy as some politicians may paint. And there's some really hard work ahead for us to turn that around. And I hope they do. I really hope they do. Whoever is in the office, blue or red, for our sakes, I hope they turn it around. Okay, so let's look at this. In a period of rise, this is like a language that just is really eloquent, but I'll explain it differently. So in a period of rising U.S. tariffs, look for Canadian-based companies with strong domestic focus or global export diversification rather than a deep dependency in the United States. So what's it saying? Does it say that you should exit supporting buying products in Canada? No, buy products and invest in companies that have a strong foothold in Canada where they're manufacturing their products in Canada and they're not really affected by U.S. tariffs, and they have a strong export component elsewhere in the world, so they're not really being crushed by the fact that we have such a tariff in Canada because of the United States. It's a little bit hard for you to do that if you're just doing it yourself. If you're working with an advisor, they might be able to help you do that. But let me just give you from a 30,000 foot level, not 30, let's go 10,000. Let's bring it in a little bit tighter than that. So what you want to start off with is having a lower Canadian weighting in your portfolio. I don't see the value. Maybe banks, because banks tend to make money in all the environments. They are not going to cut their dividend. They've never cut their dividend in modern time, I can tell you that. But besides that, that would be the only place I would favor Canadian content, is maybe the dividend coming out of a Canadian financial, one of the top 5 banks. USA having a higher weighting, but also being careful about where that is. And so I put the sector weighting. So you really want to be technology, real estate, utilities, and financials. The AI train is still chugging along. Yes, we're going to see a problem in the United States. So what problem in the United States are we facing? In November, we're going to have the Supreme Court of the United States provide their decision on whether the tariffs are legal or not. My belief is that they are going to be against Trump. I'm not saying that I'm for or against Trump. I just looked at the facts. I did a video about this. You may have watched it, where we examine how did Trump use the tariffs, under what rule did they use, and it's my belief that that rule is not going to stand. That doesn't mean that it may not mean that they give money back. Maybe they do. I don't see that happening, but I'm certain that they have another strategy ready to go in place of the tariffs, so that they don't lose all of this investment, because President Trump is campaigning, but he is telling everybody the hottest country in the world right now is the United States, and that is because of tariffs. So he does not want to lose that. So that's why I'm still thinking that the United States is a place to be. Know that you might see a small decline or a decline over a small time frame in November, and then I see the U.S. economy still going. It's hard to move away from a country where they're spending $2 trillion on AI every year. That's a hard thing to move away from. So I would still be in the U.S., but Canada, oh, that's a problem. So let's look at portfolio allocation. This is an example of a global fund. I'm not going to say what kind of fund it's not. I'm not going to say ETF, mutual fund, segregated fund. I'm just saying this is a global fund. And you can see that in a global fund, the weighting in a global fund is always going to be heavy weighted US. So if you're in a global fund, you're going to achieve that overweight position in US. But you can see there's other countries in there where they're investing. This particular fund, this is what the return has looked like over the last, since 2000, so we're looking at 13 years of fund performance. And you can see 10-year is more than 10%. So I'm not sharing with you a crazy example of 32%. I'm showing you a very moderate type of investment that gets you the kind of return you probably would be excited about, or feel like you weren't at too much risk. So that is an example of a global equity fund. All right, so that's the end of today's video, and I hope you enjoyed it. Tell me, what did you think of the video? Was it good information? Is it going to help you? I want to ask you a question, as I always do. Do you have any confidence in the Canadian economy over the next year or the next 12 months? What do you think? Is Canada going to be booming, or do you think it's a place of concern? Put your comments below. I love reading your comments. And again, I appreciate you watching today's video. Like and share it with everybody that you feel needs to get more information about investment and retirement planning. And I look forward to seeing you in the next video. Thanks, and be well.